All right, let's talk about stagflation. It's a word you're probably hearing a lot more lately, and for good reason. It's kind of like an economic storm that can brew quietly. And right now, we're going to take a look to see if those clouds are starting to gather. If you just glance at the headline numbers, you might think things are doing just fine. Inflation, while it's still a thing, is way down from its crazy peak. And the official unemployment rate, honestly, by historical standards, it actually looks pretty good. Okay, so this is the big question, right? If the numbers look okay, why is there this growing feeling of, well, unease, even panic behind the scenes? It seems like there's a story that the official data just isn't telling us, and that's what we're here to figure out. First things first, before we can really spot the danger, we all need to be on the same page. So, what exactly is this thing we call stagflation? Think of stagflation as one of the absolute worst-case scenarios for an economy because you're fighting a war on three fronts at the same time. You've got prices going up, which makes everything more expensive. You've got people losing their jobs, and the whole economy is just stuck in the mud. Any one of those is bad, all three together, that's a real nightmare. And here's where it gets really, really tricky. This is the central problem. The normal tools that policymakers use to fix the economy, they start working against each other. If you want to fight inflation, you jack up interest rates, but that slows down the economy and costs people their jobs. Okay, so you want to boost growth. You cut interest rates, but that can pour gasoline on the fire of inflation. It's an economic knot that is incredibly hard to untangle. So, the plot thickens when we start to pull back the curtain on the very data we're told is a sign of strength. The numbers, well, they might not be adding up the way we think they are. So you open the news and you see a number just like this, 3.6% unemployment. And that looks fantastic, right? It suggests this super strong, booming job market where basically anyone who wants a job can get one. But is that single, tidy little number really telling us the whole story? Or is it actually hiding some pretty serious cracks in the foundation of the job market? What that number doesn't count might be the real story here. Well, here's the thing. That low unemployment rate, it doesn't count the millions of people who've just given up looking for a job. It doesn't show the huge rise in underemployment, people with college degrees driving for Uber to make ends meet. And get this, you are officially counted as employed if you work just 1 paid hour a week. 1 hour. And to top it all off, we just had this massive revision showing the economy created almost 1 million fewer jobs than we originally thought. The picture starts to get a lot fuzzier. And you see a really similar story with inflation. We hear that the main metric, the CPI, is getting better. But that number doesn't really capture shrinkflation, when your bag of chips suddenly has a lot more air in it for the same price. It also has a bad habit of underestimating how much housing really costs. And here's the most important part. Even if inflation magically gets back down to 2%, that doesn't undo the fact that prices are already up 30% in 5 years. That money's gone from your pocket, forever. Okay, so let's move to the next piece of this puzzle, because the very engine that's supposed to be driving our economic growth, it's starting to show some serious signs of strain. Now, on the surface, our GDP growth has looked pretty solid, but when you actually pop the hood and see what's powering it, you start to see some red flags. A huge piece of that growth is being held up by government spending and spending by the wealthiest consumers, two things that might not be sustainable in the long run. And about that government spending, here's where it's coming from. A massive chunk of our recent growth has been fueled by government debt, and that debt has just exploded. It's more than quadrupled in only 20 years. This isn't just some abstract number. This is like building our entire economy on increasingly shaky ground. Look, at some point, the bill for all that debt comes due. And historically, the way governments deal with that is something called austerity, which is just a nice word for a really painful mix of deep spending cuts and big tax hikes. And that would slam the brakes on the economy, likely triggering the exact stagnation and unemployment we're trying to avoid. So this brings us to what might be the most critical part of this whole story. A direct conflict, a tug of war, happening right now between the two most powerful economic forces in the entire country. Think of it like this. Managing the economy is like trying to play a really complex piano piece. You have one hand, that's the Federal Reserve, using monetary policy like interest rates to control the tempo. And then you have the other hand, that's the government, using fiscal policy, which is spending and taxes, to play the actual notes. For the music to sound good, both hands have to be perfectly in sync. But right now, they are not in sync. Not even close. In fact, one hand is actively fighting the other. The Fed is hitting the brakes, trying to cool things down and fight inflation. At the exact same time, government policy, spending, and tax cuts is stomping on the accelerator, and that's creating this massive friction right in the middle of our economic engine. And that fiscal policy, it's having a very weird effect because a lot of it has benefited higher income folks. We now have this situation where the top 10% of households are responsible for half of all consumer spending. This is creating what some call a K-shaped economy, where things are booming for a small group at the top, driving up inflation, while the other 90% are struggling to keep up. So this puts the Fed in an impossible spot. How do you set one interest rate for two completely different economies? Okay, for our last point, let's zoom all the way out. Because a stagflation problem in America isn't just an American problem, it's a problem for the entire world. And this is a really important question. You might look around the world and see other places with similar or even worse economic numbers. So why is everyone so focused on the US? Well, the answer comes down to the absolutely unique role that America plays in the global financial system. See, the world basically runs on the US dollar. It's the global reserve currency. Oil, commodities, international trade, it's all priced in dollars. So if the rest of the world loses faith in the stability of the US economy and therefore the dollar, it could set off a catastrophic global financial crisis. And on top of that, the US has fewer social safety nets than most other wealthy nations, which means a bad downturn here could cause much deeper social problems that would absolutely spill over to the rest of the world. So that's the key takeaway here. The US isn't just another domino that could fall. In many ways, it's the table that all the other dominoes are sitting on. The stability of the entire global financial system is fundamentally tied to the US being able to avoid this stagflation trap. And all of this leaves us with one final, pretty unsettling thought. When you have misleading data, a deeply divided economy, and policymakers pulling in opposite directions, it's entirely possible that the US is already in the early stages of stagflation, and we just haven't admitted it to ourselves yet. The real question isn't just whether the storm is coming, but what happens when everyone finally looks up and realizes it's already here.